And this is where we'll get into the numbers. We'll look at the actual pre-approval process. So one of the steps in the home buying journey is analyzing your personal budget. Putting pen to so-called paper and looking at what's coming in monthly and where it's going monthly. Do you have a budget? Most people don't have a budget. So we're going to look at an example here where this borrower, we assume they're making $100,000 annually. So you divide that by 12 and you come up with a monthly gross income figure of $8,333. So gross income is the same as pre-tax income. It's before anything is withheld from that borrower's paycheck in the form of taxes. So you look at the typical breakdown. 36% of someone's monthly budget should go towards debts. 31% comes out, usually withheld by the employer in the form of taxes to Uncle Sam, and then 33% out remaining goes to everything else as far as living expenses on a monthly basis. So in this example, we're looking at this borrower has a new mortgage payment of $1,400, a car payment of $600, student loans $400, credit cards at $200, which gives this borrower total monthly expenses of $2,600 a month. The next calculation is probably one of the most important calculations a home buyer and a lender uses in determining how much that home buyer qualifies for in terms of mortgage financing. And this is the calculation of the debt ratio. So in this example, again, we have monthly expenses $2,600 a month. You divide it by your pre-tax or gross income, which in this case is $8,333, and you arrive at a debt to income ratio of 31.20%. That is well below the threshold that lenders like to see of 43%. Anything above 43%, your loan may not be approved. I say may because there are other variables that are taken into account. One, the lower of a down payment you're putting down, the lower a lender likes to see your debt ratio be. If you're putting down only 3%, and your debt ratio is over 43% and you have marginal credit, limited reserves, chances are you may not get approved. If you're putting 20, 30% down, you have a debt ratio over 43, maybe 45, the automated underwriting system that every lender uses still may approve that loan. But for general guidelines, lenders like to see a total debt ratio of 41 to 43%. What's not reflected on here, however, which is another calculation lenders use in determining how much you qualify for, is your housing expense ratio. And typically, lenders like to see your total monthly income about 28 to 31% be allotted towards your housing payment, which includes your principal, interest, taxes, and insurance. Something else not reflected on this page, but should be taken into account by home buyers, you probably could guess it if you're unmuted, are cable bills. A lot of people have $250, $300 cable bills a month, $250, $300 cell phone bills a month. So even though a lender does not hold that against you in calculating your debt ratio, you as the home buyer have to think, okay, this looks great on paper. I only have a 31% debt ratio. And maybe you have a child or two in daycare. One child, I think, could be $1,500, $2,000 a month. So if you factor those variables in, your debt ratio, again, you may qualify on paper, but in reality, your debt ratio may be 48%. And again, this is based on gross income before taxes. And we all know you contribute to a 401k, what your net is after taxes, your 401k contribution, your healthcare contribution, that net bring home pay is much lower than gross income. So just take that into account. You may want to get pre-approved for the maximum amount you qualify for, which is smart, but it doesn't necessarily mean you need to purchase a home using the maximum amount of financing. You don't want to be so-called mortgage poor, where you have nothing to live off of at the end of the month, otherwise known as discretionary income, to cover things like vacation, or cover an illness, to cover a roof repair, or replace a hot water heater when it goes. So just keep that in the back of your mind. Other costs to consider in the home buying process. Down payment. In this example, we're using 5%, but please know you can get in, purchase a home for as little as 3%. There are some government programs you can get in, do 100% financing, such as in the case of a VA, Veterans Administration loan, or a USDA loan. USDA loans are limited to certain geographical areas, usually agricultural areas. But for this example, we're going to assume this bar is putting down 5%. So 5% on a $250,000 home purchase equates to $12,500. So you have to look, well, do I have this down payment? Do I have it in the form of savings? If not, do I have a gift? Can I get a gift from a relative? It has to be from a relative. If so, that's fine. Again, we'll get into this a little further in the presentation. We have a home buyer program, first-time home buyer. You can do 97% financing, and 3% can be from a gift. So basically, you can get into it with limited funds out of your own pocket. And the next category, seller assist, that really doesn't apply in this market. Most of you on the seminar probably are aware of the imbalance of supply and demand in housing inventory. There's been a shortage of housing inventory, even predating the pandemic. I would say the past 5 years. The pandemic has greatly exacerbated the issue. However, seller assist is most offers are being accepted usually over list price, and they're not including any seller assist. As the markets normalize, which someday it will happen, the supply and demand will come back into balance. Instead of it being a seller's market, it will become a so-called buyer's market. Seller assist will come back into play. But I would think for now, in the short term, just keep it in the back of your mind, seller assist really is not available. Closing costs typically is 5 to 7% of the purchase price. So you have to consider the down payment, whether you're putting 3% down or you can put down as much as you want. And you have an origination fee, appraisal fee, credit report fee, tax service fee, title insurance, recording fees, which are paid to the county municipalities for recording the mortgage and the deed. You have escrow, the establishment of your escrow to pay your taxes and insurance with your monthly mortgage payment. When those tax and insurance bills come due, you have to set up sufficient funds to establish your escrow account. So all these are considered closing costs. Now, a lot of these are just pass-through fees. For instance, credit report fee. We incur a charge when we pull your credit report. So lenders not making money on these fees. These are fees that lenders incur, but you ultimately end up paying them. So what is the pre-approval process? We'll take a look at who, what, when, where, why, and how. So who should get pre-approved? Basically, everyone who's house hunting. It shows you're a strong qualified borrower. Now, pre-approval is a letter for not only your realtor, but you, showing you how much house you can afford. When should you get it? You should probably obtain it a month or two before you start house hunting. And where any lender can prepare this for you, and Citadel will be more than pleased to assist you and issue you one. Why? It lets everyone know how much house you can afford. Excuse me. How does a pre-approval work? Well, we would take a look at your credit, your employment information, your asset situation, such as your checking, savings, 401k funds, to determine how much house you can afford. And they're free of charge. And typically they're valid for 120 days after the issue date.